Welcome, folks. Um, this is the market review for gold. So today we had a bearish day. So as you can see, this is today. So we had this liquidity void. So that would have been a potential drawn liquidity. And also we had these from this candle's low to this candle's high. That becomes also a fair value gap. So we had a volume imbalance, a liquidity void, sorry, and also we had a fair value gap. So that would be a draw on liquidity. So we mark those, especially the liquidity void. So we had that. So from the low of this candle to the high of this candle, so you extend it through. You can join, you can couple it together with this fair value gap. So we had that. So this is the daily chart, as you can see. So we had this run high, and then we had a bearish run to the downside. So we had that. So here we had the power of 3, which is accumulation, manipulation, and then we had distribution. So if we head over to the 15-minute chart, let's see how could have traded this. So this is the volume imbalance, the liquidity void, sorry. So we had that. So at 2, around 2 to 3, which is the ICT London Open kill zone, we had a fair value gap that was created, and also we had this as the midnight candle right there. So we had that, and we had this run to the upside, which is came out to these highs, and then we had this shift in market structure after buy side has been taken. Then we have a shift in market structure. The draw is to the downside. So we had this candle that created a fair value gap. So we had that. So we mark that candle, extend it through, and then during London Open, exactly at London Open, we had a run to the upside, and then we had a run to the downside, taking out these lows and eventually trading inside these liquidity void. So we had a run to the downside, and then it acted as resistance, then it pushed price to the downside. So we had that, and then I guess we had news today with this push up high, taking out these highs, and then right now we are trading to the downside. So again, this was used as resistance, as you can see. So we had that. So if we go to a 1-minute chart right here, so had this, we had these relative equal highs taken out right there, and then we had a swing low taken out, and then we had, as you can see, this kind of traded to the upside. This is what we call institutional order flow entry drill. So we had that. So an institution order flow entry drill is whereby a gap doesn't fill entirely. The gap remains open. So we had that. Also we had these inversion fair value gap. So couple them, as you can see, we had a push up into the midpoint of the fair value gap, the 15-minute fair value gap. So it touched that the midpoint, trading inside these imbalance also, then an aggressive move to the downside. So if you are to go short, be going short. If you're quite aggressive, going short right here, and also it could be going short inside these inversion fair value gap. So you had that. So we had that there. The stop be placed right above there. Then the draw liquidity, which was the fair value gap. So you had this as your draw. So you don't expect a liquidity void to be partially filled in. You expect it to go through it and maybe even come back again to reprice, because there was no trading that took place inside the liquidity void. So this was a good trade. It was around 18.55 hour trade. So it was quite a good risk to reward trade. So you had that. So when these lows were taken out right there, you trade your stop to break even, take partials around this level, and then hold for your TP to get hit. So we had that, and eventually we hit our target. Then here we are again. It came back, acted as resistance, pushed price to the downside, and here we are. So we're expecting even a sweep below these lows. So I guess that's it for gold for today. Till I talk to you next time, be safe.